Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, we bring you the latest trade headlines from Washington as we look for more tariff letters, a deal with the EU potentially, and as President Trump threatens hefty levies on Brazil. Plus, we dig into earnings as Delta soars after reinstating its guidance. Is the worst of the trade war behind corporate America? And early data pointing to a big sales slump for Amazon's flagship sales event. We'll break down what it means for the company and what it spells out for the consumer. Let's go to check on the markets right now. Taking a look at the major averages, we've got a mixed picture here. The Nasdaq slumping today, down about 0.4%, leading the declines. The Dow going in the opposite direction, up a little more than 45 points here, and the S&P hovering in the middle. So overall, let's call it mixed to little change today. Let's also get a check on bond yields today. We continue to watch the situation with the Federal Reserve as the White House tries to put pressure on the Fed and on Jay Powell to cut rates. We're seeing yields actually bump up a little bit today, but they've really been trading in a range. Let's get to the latest trade headlines now. In his latest round of letters, President Trump threatening to impose 50% tariffs on Brazilian goods, citing what he says are unfair trade practices and the persecution, in his words, of Brazil's former president Jair Bolsonaro. Unlike many other countries that have been threatened with tariff hikes, the U.S. runs a trade surplus with Brazil and has for many years. Joining me now, Barbara Duran, BD8 Capital Partners CEO and CIO, and Jayati Bhardwaj, a TD Securities FX and macro strategist. Also our Ben Werschel, our Washington correspondent. And Ben, let's start with you and the latest that we are hearing on the trade front.
Sure thing, Julie. So you started with three overall catalysts. I'll give you three kind of sub-catalysts within this trade story that we're watching closely today. The first one is the one you mentioned, these spiking tensions with Brazil. President Trump surprised a lot of folks with a 50% tariff threat on Brazil last evening over this trial of its former president. The current Brazilian president has already shot back that they don't take orders from the U.S. And so tensions are rising there overall, with trade now sort of center stage for that. And so that's a story that we're going to be following today. The second one is Europe. This today is Trump's self-imposed deadline for either a deal or a letter with the European Union. This is the biggest kind of economic shoe to drop this week because the European Union as a bloc is America's largest trading partner. He said they're about 2 days away from a letter on Tuesday, so we're now at Thursday. So we're waiting to see how that pans out. The parameters of a deal have been circulating widely, which would be a major development if they go through, which would be a 10% baseline tariff with details to come on carve-outs for different industries in there. But that would be a major deal if that can get over the finish line this week, although nothing is set until the August 1st deadline. And then the third sort of sub-catalyst here are these more letters. There's over 100 other countries, other than those ones I mentioned at the first two, that are still outstanding. Trump has sent 21 letters so far, with ranges of 20 to 40% all across the world, and we're expecting more of those today as he kind of irons out this August 1st deadline as the next key one that he says is immovable, but traders are clearly watching closely.
Watching closely, but not necessarily selling as a result of this, as we have seen. Barbara, I want to start with you on what we're seeing in the equity markets, which is not much in terms of reaction to all of this. We've been talking with Ben a lot about this too, that maybe there's just not really taking seriously that, the market does not seem to be pricing in, for example, that a 50% tariff is really going to be imposed on Brazil, right?
Right. Yeah, Julie, I think you're absolutely right. Now, the market is discounting based on his past behavior leading up to this, after we had the April 2nd announcements when the market sold off dramatically, thinking this really is bad. And it would have been very bad if he hadn't backed off. And we had the 90-day pause. So now that he's coming back, it is very widely seen that it's a negotiating tactic, that he is sending these letters out and telling people this is what will happen if you don't come to the table. And so this 50% moves, or the 20 to 40% range in general, is probably not going to stick, is what the market's assuming. Now, if we're wrong, it's going to be a nasty shock. But right now, I think that's clearly what the market is expecting.
And Jayati, let's talk about it from the FX and currency perspective, right? Because there was this concern that was really bubbling up more strongly earlier in the year that the U.S. position in the world was fundamentally changing, that maybe foreign investors would not be as keen to invest in the U.S., and that was having a ripple effect. Where are we on that sort of thinking now?
I think that's a very good question, because you can see the differences in the impact things have had in the equities markets versus the dollar. Equities have rebounded, even yields have tried to go back up. Commodity prices at one point, have tried to go back up again, but the dollar has unidirectionally moved lower. In fact, the dollar has really struggled to hold on and sustain any rallies, which I think is signaling a structural shift in the preference of investors for the dollar hoarding, which they had been practicing for the last few years. In fact, what we've been seeing is that the global investors of the world are now hedging their long US asset exposure a lot more, which requires them to actually sell dollars in markets, which is creating this sustained pressure lower in the dollar.
And there's been a lot made of whether this is the end of so-called American exceptionalism, Jayati. Is that what we're seeing effectively play out in the currency markets?
I think, yes, that definitely. A lot of the times people have been asking about the sell America trade. Is this the end of dollar and US exceptionalism? It is definitely the US exceptionalism waning. The gap between the US and the rest of the world is shrinking after a very long time. And the first place you can see that is in the currency markets, because the dollar is not behaving how it usually tends to behave. A lot of the traditional correlations that we've been used to in markets are not working the way they have been. In fact, the dollar at sometimes has been given the status of an emerging market playbook. We saw that when markets got concerned about the deficit projections with the bill. We saw that when Trump first came out with the tariffs, when markets started flocking more to currencies like the euro and the Japanese yen over the dollar. So definitely you see that shift and lack of dollar exceptionalism, which is also why Trump has been threatening the BRICS nation, who did mention that they want to start trading more in their local currencies.
And so, Barbara, what are the implications of that lower dollar for U.S. companies also? Is this something that investors in U.S. equities have to now kind of factor in when they're looking at profit models?
Yeah, yes, but in a good way. I mean, if you look at the S&P 500 companies, over 40% get most of their earnings from abroad. So that's going to be a real positive. And coming up, as you know, we've just started today with Delta in the second quarter earnings, and next week the big banks, of course. But you're going to see a lot of the companies with international revenues, which includes a lot of the Metas and Apples of the world, are going to have a real tailwind there behind them. So in a lot of ways, it's going to be positive for American companies.
Ben, I'm curious too, we've kind of had the administration at different times take different tacks when it comes to talking about the U.S. currency. What's the current thinking in the administration?
Yeah, this has been a big mix from this. You hear a kind of a divide there from different Trump aides about the sort of the strong or weak dollar. There is a kind of case here that tariffs kind of helped Trump overall here. You hear that a lot from Stephen Moran, who is his Council of Economic Advisors. But Trump has offered mixed messages on this. You see, sometimes he's kind of a stronger dollar. Sometimes he's sort of open to lessening it some. It's been a big focus this week from currency around the BRICS that was just mentioned. There was a BRICS meeting earlier this week that clearly pushed Trump to threaten this additional 10% tariff on BRICS, partly because there's an idea floating around there that could launch a rival to the dollar. He's clearly most interested in sort of tamping that down, but the day-to-day levels of the dollar, he kind of changes his message on.
Yeah, Jayati, let me ask you about that. Is that a realistic concern that the BRICS would somehow come out with a currency, or that one of their individual currencies would be a real competitor to the dollar?
I think the BRICS has floated the idea of having a unified currency, which I think is unrealistic because that needs them to have a unified monetary policy. But given the very unique emerging market nations that make up the BRICS summit, I think that will be very hard to achieve. What they can do alternatively is start trading more in their local currency and settling their trade balances in local currency instead of the US dollar, which I think is something that Trump picked up. We were just talking about, Trump wants a stronger dollar, weaker dollar. I think sustainably, we all know that Trump is trying to shrink the trade deficit. For that, ultimately, you do need a weaker dollar. But what I think does not sit well with him in the short term is if that dollar weakness is coming from a loss of confidence, and if it's being initiated by other countries thinking about diversification away from the USD. I think he wants it more where he is more in the deciding power, where it could come, let's say, through a currency accord, which the US strikes up with the rest of the world, but he does not want that dollar weakness to come from a loss of confidence.
Let's talk about the Brazilian real for just a moment here, given that 50% tariff threat. And of course, the irony here is, as we talked about at the top, we have a trade surplus with Brazil, not a trade deficit. And we've had, at least for the past, several years. So what are you looking at when you look at specifically the real, which we see, moving lower a little bit today, but the dollar has been weak?
I would say this is the first time that I think Trump has come out, sending a letter, and that too with a very high tariff rate to a country with which we all know that the US has a trade, surplus with. In fact, Brazil was not even in one of the initial countries when the reciprocal tariff list was announced. So this is quite surprising, to markets when they are thinking about the risks and the uncertainty. I think the level of uncertainty just shot up a lot more because earlier when markets were trying to think about how to deal with the tariff headlines, which keep changing every few weeks, they earlier thought these are the countries we need to focus on. These are the reasons that Trump has pointed out. It's the trade barriers, the tariffs, and the the non-tariff barriers. But now it has broadened the risk because now we don't know what all Trump can think about in terms of using these tariff letters in terms of targeting certain countries. That is why the uncertainty has gone up, which is why the dollar is stronger today. Was stronger yesterday when we got the letter to Brazil. Is stronger today versus the euro when we are concerned about what letter will be sent to the EU. And also in the short term, everyone has been bearish the dollar, so it was looking very cheap. So we have been cautioning investors that you can see a bounce back or a pop-up higher in the dollar, which should actually give you better entry levels to sell it for more structural reasons.
So you think over the longer term, the remainder of the year, that the direction of the dollar continues to be lower, even if it does see some near-term pops?
Yes, because there are a lot of more structural factors at play which are now driving the dollar weaker. For many years, people have said the dollar is overvalued, it has to weaken, but it has never been able to, because you always saw why the US was extremely more strong in terms of growth, productivity, and other means, stronger than the rest of the world. But that gap is shrinking from both ends now. The US, because of its policies, which will hurt growth, lead to higher inflation, and the rest of the world is now having to step up and do a lot more fiscal domestically. So that gap is bridging from both ends, and we've seen a change in investor preference for hoarding onto the dollar because they're not doing that anymore. So these structural factors will remain in place for the next few quarters to come.
And Barbara, finally want to ask you again from the equity perspective, when you're talking about trade, even though trade doesn't seem to be, and tariffs don't seem to be having that much of an effect overall on stocks, certainly there are individual companies and sectors where there is more of an impact. So how much are you taking that into account when you're trying to decide where to invest right now?
Well, I think one of the biggest areas and the most obvious areas in the retail sector. And that's where we're waiting to see. And we should start to see this flow through in this next month or two in terms of what they're doing about supply. Because as we know, there was a lot of forward ordering and stocking of inventory while it was cheaper, but now it's starting to hit home. So we want to see what happens, how much they are pushing back on their suppliers, how much of a margin hit they'll take, how much of the pricing they're going to pass on. So I think in the retail area, you've got to be cautious, and you've really got to look at where the supply chain is for individuals. Like, for instance, the Williams-Sonoma has not only 25% from China, but a lot of their suppliers have their supply coming from China. So there's going to be pressures, in the retail sector, because let's remember too, on the imports, it's mostly we're talking about hard goods, not services. So that's really where you want to keep your eye on. But we're going to have a lot more information, a lot more facts flowing through in this next few months.
Yep, we'll be getting earnings, so that'll be very interesting. Thank you to Ben and Jayati. Barbara's going to be sticking with me. And we got much more markets action coming up ahead, including some individual movers. You're watching Market Catalysts. Now time for some of today's trending tickers. We're watching AMD, MP Materials, and Roku. First up, AMD getting an upgrade from HSBC analyst Frank Lee to buy. He says the company's artificial intelligence chip could be a positive catalyst for the stock. He's also raising his price target for AMD to $200 a share, up from $100 a share. The share's up some 4% right now. And obviously, NVIDIA sort of has been controlling the market for GPUs related to AI, and we have seen it outperform its main rival, AMD. NVIDIA shares up some 20% year to date, and we know that they are close to that $4 trillion valuation. AMD is actually up 18% year to date, hasn't done bad, but still it sort of lags NVIDIA in that particular area. Next up, MP Materials shares higher after that company announced a deal with the Department of Defense to build out domestic rare earths manufacturing. Shares jumping on the news because the deal includes also a $400 million investment from the Department of Defense, as well as $1 billion in commercial financing. It aims to reduce U.S. dependence on imported rare earths, which go into a number of different types of technologies. And MP is effectively the only producer here in the U.S. through a mine in California, but it is trying to open a second manufacturing location. This would make the Pentagon the largest shareholder of this company. And finally, Roku getting an upgrade from KeyBank analyst Justin Patterson to overweight from sector weight. He raised his price target to $115 a share. Patterson expecting Roku could become profitable by the end of 2026 and expects its post-April rally has more room to run as more ad dollars begin to be spent on streaming platforms. We have already seen some interesting activity in Roku thus far this year. There's been a lot of enthusiasm around the stock, although it's not moving much today. It's up about 19% year to date. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, takeaways from Delta's earnings. Stay with us for that. Shares of Delta Airlines opening higher after reporting an earnings beat for the second quarter and reinstating its full year guidance. And not just higher, by the way, up 14% today, an unusual move for the airline. Joining me now, George Ferguson, Bloomberg Intelligence Senior Aerospace Defense and Airlines Industry Analyst, Barbara Duran, BD8 Capital Partners, CEO and CIO, still with me, and Yahoo Finance Senior Reporter Pras Subramanian as well. Pras, let's go to you first to sort of set the stage here for Delta, because as we know, Delta was one of those first companies that came out, pulled its forecast, said there's too much uncertainty. So now they're coming out and saying, well, we got a little more certainty now.
Yeah, CEO Ed Bastian talking about how trade deals, the big budget bill coming to pass here, sort of added more certainty, removed some of the overhang of what's going to happen in the future, and this led to sort of the reinstatement of their guidance back in play here. The stock moving much higher here as the trading day goes on. The call going on right now with analysts. But yeah, I mean, the focus on premium also is a big deal here. That premium segment growing for them, both in terms of the loyalty business, credit cards, but also the higher end sales to business travelers and wealthier leisure travelers. That's sort of driving their business. Main cabin or economy business kind of going down, so that's not looking that great for them. But it seems like investors here are really focusing on that return of the guidance, but also Bastian's comments on confidence and sort of seeing more growth in the second half of the year.
Yeah, George, do you think that is really the most important takeaway here?
Yeah, so I mean, I think it is reassuring that Delta was willing to provide guidance again, but I would note that guidance was lower than original guidance at the beginning of the year. And when we looked at earnings, what we saw was that in every market that Delta delivers seats into, yields and unit revenue, which is the sort of the average price paid per seat flown, not necessarily filled, was down. And so I think Delta's counting on less capacity in the back half of the year for the industry in entirety to support fares. But we continue to see fares slide, and we see United, Delta, and American continuing to add to the seats in the marketplace in 3Q.
And so, George, when you hear Ed Bastian sort of expressing optimism about the second half, is it sort of from a lower base, or do you think his optimism is a little bit misplaced?
Well, so I think it goes back to Ed is continuing to count on that premium traveler to give United, American, Delta, but he's talking mostly Delta, or all about Delta, a better revenue environment than their competitors. But again, if you look at 2Q earnings, they grew 4%-ish, I think, and their revenue was flat. So they're in a market right now that looks overcapacitized, and they're going to add to it in 3Q. I think it's going to be okay. It's not going to be great. We're not off to the races in this industry. I think we still have a little too much capacity, and we're trying to rationalize it. We'll see how it goes.
And Barbara, we'll see how it goes. It's not going well enough right now for you to want to be in airlines, right?
No, I don't think so at this moment. I mean, the big takeaway for me is the confidence of the management, which is what I think is being reflected in the market as a whole, that managements are finding a little more stability and a little more ability to project out. And so on the airlines, this is just another case. But I think what George was pointing out, is there is softness in fares, there is softness in seats. And I think even though the high end of spending and airlines like Delta or American or United will benefit from the higher income consumer and business still spending, there is definitely weakness showing up on the lower income. And so airlines still are cyclical, and I think probably the stock bounce up here, maybe it has a little more to go, but probably not a lot from here given the softening in the economy.
Hey, George, this is Pras here. I spoke to Ed Bastian yesterday about the earnings, and he mentioned that overcapacity, I think you mentioned too, is a problem. Also hinting that there might be some competitors that might go away. Is that sort of how you feel too?
Yeah, I mean, we see some of them like Spirit Airlines, they're in trouble. And when we look at 3Q, the setup right now is that some of those ultra low cost carriers, Frontier, Spirit, cutting seat capacity considerably. So that's going to help in 3Q. But again, the big full service carriers keep stepping on the gas to a certain degree because they're getting that premium revenue. At some point, I feel like that's gonna run its course on them. But again, I guess we'll see. But there are some folks that may leave.
I'm also curious, we've been talking a lot about the demand side of the equation. Let's talk a little bit about the cost side of the equation. I'm seeing on the conference call that Delta said it raised employee pay 4% during the second quarter. So we have labor costs on the one hand. On the other hand, and I know Delta, like many airlines, does hedging for fuel costs. We have seen fuel costs come down to some extent. So George, talk to us about the cost side of the equation and how that's shaping up.
Yeah, so what you're seeing right now is going to be the best performer in cost probably this quarter, either them or United. And so the challenge is if you stop growing in this industry, you're losing that ability to lower your cost per available seat mile by spreading out whatever sort of fixed costs over that you have over more seats. And we're seeing the full service carriers doing a better job of containing costs because they're growing capacity. Their low-cost competitors having more difficulty because they're cutting capacity, and that's hurting their cost per seat mile and hurting their profitability. Delta's done a good job, a very good job. They should be lauded for that, and they'll give some back to the employees, which is nice to see, I guess.
And Barbara, I know that you pay a lot of attention to sort of consumer confidence and spending data, which relates back to the airlines, but beyond the airlines as well. So what are you thinking about the consumer and the willingness to spend right now?
Well, I think, the word resilience is used a lot, in describing this, but I think that's what we're seeing because when you look at the employment numbers, certainly last week was a surprise that unemployment actually ticked down from 4.2 to 4.1%. Wages are growing about 4.2. So people right now, even though there's not lots of new job creation, we're seeing that, in the stats. People have jobs, they're employed, the wage growth is above inflation, and there's still really good savings. People have a lot of their wealth in homes, which prices have stayed high. And certainly since the COVID lockdown, we've seen some $40 trillion in wealth created through the markets. So balance sheets are in good shape. So, barring a major downturn, which we don't see, there's leakage in terms of the economy slowing and jobs. But I think right now the consumer is basically fine, except as we mentioned earlier, the bifurcation with the lower income where there is more stress. And there's been stress for the last 12, 18 months, but that seems to be increasing.
And Pras, I know that you've been looking at the sort of weather equation when it comes to the airlines as well.
Yeah, Delta talking about how they expect the weather situation to not be as severe as it has in years past. Now we had the conditions obviously in Texas last week, but they expect that situation won't be as severe, and that means fewer delays, fewer costs, and that should help with them in terms of what George is talking about with the kind of the cost equation, bringing that down in line with their competitors.
Pras, George, thank you so much. Barbara's going to stick with me. And coming up, we've reached the halfway mark for Amazon Prime Day. We've got the latest data on how sales are going so far for the e-commerce giant and whether it should matter in terms of you buying the stock. That's next. 1 hour into the start of trading, let's go live to the NASDAQ to get a read on the biggest factors moving markets today. Ali Canal back with us. So what are you seeing right now?
Well, we're seeing markets stall out a little bit, especially after that NVIDIA-fueled rally that we saw to end Wednesday's close. But we do have the Dow in positive territory, up around 140 points. The NASDAQ is off around 0.3%, and the S&P 500 is essentially flat. Now, we did get a decent amount of news this morning. Delta reporting solid earnings, which I'll get to in just a second, but also renewed tariff threats from President Trump, this time on Brazil. So investors digesting a lot of those headlines. But let's take a look at Delta earnings, because we're seeing shares there up around 13%. Now, this comes after the company reported strong earnings, reinstated guidance. It seems like a lot of the tariff unknowns, tax bill unknowns, that's been removed here. It's something that Ed Bastian specifically referenced. We have been hearing from strategists heading into this earnings season that the bar was low. And now that we have a bit more clarity, that will be key as other corporate earnings start to trickle in here. And then let's take a look at NVIDIA, because the company reached that $4 trillion market cap for the first time yesterday, becoming the first publicly traded company to do so. We are pulling back a little bit today off of that $4 trillion mark, but still, this has just been a significant rise, happened over a period of 2 years, as you're seeing on your screen here. We do have shares today down just around 0.5%. But what's not down today is AMD. We are seeing shares move higher after HSBC upgraded the stock to buy with a price target of $200 a share. That's up from the prior 100. The firm cited strong upside in AI revenue and underappreciated pricing power of its new AI GPU lineup. AMD's chips, they're competitive to NVIDIA, and they're also a little cheaper there. So potential tailwind to come. And then finally, rounding things out with something that's a bit sweet, and that is WK Kellogg. This is a cereal arm of that former Kellogg conglomerate. We are seeing this company surge today, up around 30%. This is the maker behind Fruit Loops, Corn Flakes, Raisin Bran, and this news that we got this morning was that Italian chocolate brand Ferraro will be acquiring this company for $3.1 billion. Now, there is some commentary on the street right now that Ferraro might have overpaid for this brand, especially as we've seen cereal sales stall. We have headwinds from the Trump administration with RFK Jr. doubling down on healthy alternatives, the removal of red dye 40. So this will be an interesting acquisition, but Ferraro has been trying to increase its U.S. footprint. And for now, it seems like investors are approving this. Again, shares are up a whopping 30%.
Wow. All right. Thanks, Allie. Amazon's Prime Day sale off to a lackluster start, with the company's first day sales down 41% compared to last year. Yahoo Finance's Brooke DePalma joins me now for a deeper dive into the numbers. As I've been calling it, it's not Amazon Prime Day, it's Amazon Prime Days. Soon to be maybe Amazon Prime Week, which is maybe why the sales aren't keeping pace.
And isn't it so crazy that we all still call it Prime Day, despite the fact that it's now double from last year?
Not all of us call it Prime Day.
Well, keep in mind, this is no longer just one day. Last year they doubled to 2 days, and now it's over the course of 4 days. And so what we're really seeing here is what we've seen with consumers as of late. This idea that we're going to wait and see when we'll get the best deal, where we'll get the best deal. And so certainly, based upon those numbers from Momentum e-commerce or Momentum Commerce, is that the first day alone, sales for Amazon were down 41%. Now, keep in mind, this is now day 3. And so what will really matter here is how exactly consumers show up for Amazon on the Thursday and the Friday, the critical 3rd and 4th day. Now, keep in mind that same company, Momentum Commerce, still expects sales over the course of the 4 days to end year over year up 9.1%. So they really do expect that the wait and see approach is what will play out here, that consumers will wait till today, tomorrow to really understand the best deals. Now, keep in mind as well, the average order size is also just slightly down. That's according to new data from Numerator. They say that the average order value is $57 this year versus $60. And what we've heard from different sources is that Amazon is being super strategic with how exactly they're pricing. They're saying, hey, this is 30% off, this is 20% off, this is, maybe 50% off. And so they're being mindful with this environment where tariffs also are in play here. But of course, the competition is ramping up. It's not just Prime Week, it's sales week. It's extended July 4th holiday savings across retail. We see it from Walmart, Target, Home Depot, and Lowe's, all weighing in on this Prime Week as well.
Yeah, and one caveat I just want to mention about Momentum Commerce is they rep, I think, around 50 brands that sell through different things on Amazon. So they are a snapshot. Can we extrapolate all that out? We talked to Gil Luria the other day of D.A. Davidson. He said you can't necessarily, it's not a one-to-one comparison. So does that mean prime sales overall are down 41%? Not necessarily. So just one little caveat when we're giving that number. But from what you're hearing, what are people buying so far?
Yeah, well, certainly things that people haven't been buying is what they're taking up on these deals for. Think about household essentials being the top priority right now for consumers, but also electronics, we have apparel, we have shoes, we've also weighing in home goods, we also have health and wellness, beauty, and those key electronics. Best Buy also looking to get in on these deals here. But what matters at the end of the day is that people likely will still go to Amazon to start that shopping journey, I guess you could call it. So they're going to Amazon first, and then they're going to all these other guys to see if they have a better deal out there for these items that they're really looking for. And so that's not only boosting foot traffic for all the players here, but at the end of the day, Amazon, what I'm hearing from many sources across the street, still the clear winner here, especially when it comes to e-commerce. I know that there's roughly 77 buys on the street, 5 holds, and so lots of optimism for the company, not only as a retail player, but also with their large, AWS as well services. And they're looking to get into grocery. They're really trying to double down on that as well.
Yeah, it's interesting to see Target up today, by the way. Barbara Duran is still with us of BD8 Capital, and Amazon is one of your core holdings.
Yes.
It's so interesting to see. I mean, there's all of the, we pay attention to Amazon Prime Days, or whatever we're going to call it. But as Brooke just alluded to, AWS is still the sort of growth engine. When you are thinking about why you still own it or whether you're adding to it or not, what are you looking for in Amazon? Where does the value come from for you?
Well, their biggest area obviously is e-commerce. It's some 68-70% of sales, right? And then you have another chunk. AWS is only 17%, but it's their most profitable
more
area.
Of the, right.
And then the rest is ads, subscriptions, like this sort of thing. So it's really the fact that they continue to innovate. I mean, they're moving into pharma. We'll see how that effort goes. Very complicated area, but they just really have the power and the scale. And as you mentioned, Brooke, that is the number one place people start their search on Amazon. And there's no question they just continue to gain share. They also keep enlarging the e-commerce space, taking more share away from brick and mortar. So it's really that kind of scale and that innovation and that ability to continue to gain share. So that even if we have an economic slowdown, or who knows how much the competition, you mentioned Walmart and Home Depot, Target, because they're all in this because they've seen, wow, this is great. And Prime Day sales, whatever days we're talking about, is really in the end still only 2 to 3% of their total revenues in e-commerce, but it's an important driver, particularly in those quarters. So for all those reasons, it has been a core holding, for BDA Capital, for me personally, for years, and as far as I can see, it will continue to for some time to come.
It's also interesting to me when we talk about what people are buying, because no matter how low the price is, if you already got a TV, you don't necessarily need. I mean, so it's interesting to me that you're talking about that people are looking for home essentials, for example, on an Amazon. And I guess, to your point, if people are starting their search there, it's kind of, it's ingrained into people's lives now to such a degree that they have, whether, there's the marginal spending on things like TVs, but there's also the base spending where people are using it.
Right. No, and I think that's right, because they've expanded so many areas. They're going to start out as books, and then they added groceries and even small incidentals, which I do. Even something that's $2 because it's easy. I just go, whoop, and off it goes. So I think that continues, and also with their delivery system, they continue to improve that. I mean, I'm sure here in New York City, you've seen these little Amazon cabs running around. The guys bicycling. I mean, they keep doing that, and they're talking about drone delivery out in rural areas. So they just keep upping their game and making it better service.
Are you guys adding it all to your positions, or are you pretty steady with the Amazon?
Any new accounts that come in, we always add, but in terms of risk management, you keep the positions to a certain size. Gotcha. So I have an overweight in Amazon because of its steadiness. So, but like any position that gets too oversized, I trim back for risk management purposes. But
thanks, Barb. Thanks, Brooke. Appreciate it. We got much more markets action coming up. You're watching Market Catalysts. Well, Uber shares are down a little bit today, but they're trading near a record. And as we look at rideshare stocks, year to date, Uber is the big outperformer of the broader markets. It's up 60% compared to the S&P 500. It's about 6% gain. Lyft is also outperforming. Those shares are up about 20%. And 9 months ago, BD8 Capital Partners CEO Barbara Duran made the call to buy Uber sales and shares and to avoid Lyft. Let's take a look.
They've got dominant market share, and they're just growing their share. They're about 76%. Lyft, which is the only real competitor in the space, is at about 23%. It's going to be very tough, because you've got the virtuous circle going with Uber in a big way. You get more drivers because there's more passengers, there's more demand, and that just keeps escalating up.
Barbara, that was winter us. Now it's summer us, and the call looks like it was pretty good 9 months later. So are you sticking with it? Or are you still thinking about them in the same way?
I am actually. As you saw the differential in performance just this year alone, 60% for Uber versus 21% for Lyft. Although interestingly, in the first quarter, both of them had identical increases in revenue, 14%. But for Uber, it's a diversified business. They have the ride sharing. They also have been moving into, in the last year or so, into delivery of freight, convenience, grocery. I think that's off to a slow start, but they've got dominant share. 75, 76%. And they have a great balance sheet, some $7 billion in cash sitting there, another $7 billion in a share buyback, $2.2 billion in free cash flow the last quarter. So they've really got the financial chops. Having said that, however, Lyft is doing okay. It's a question of, where do you see continued outperformance? Mm-hmm. And again, if you have to make a choice, you can do a pure play by Lyft, but I don't think you're going to get the returns that you can with an Uber because of their diversified business, the fact that they are executing very well, and they're really bringing on new products and new services because they have the resources to do it. And I also, by the way, might point out over a 5-year time frame, Uber is up 215% versus Lyft is down minus 51%. Yeah. So I just think you always stay with the strongest leader in a space.
I'm also curious, something else that we've talked to investors about is Uber's AV strategy, its autonomous strategy, where it's sort of using partners. Tesla is expanding its robotaxi slowly, but incrementally. Waymo's out there. How do you think Uber sort of fits into that?
Yeah, it's a very interesting question because Uber had a big sell-off a few months ago because of the concerns about robotaxis is going to take share. And when you really looked at it, you said, gosh, it's very expensive to have a fleet of robotaxis. The cars themselves are extremely expensive. And so what's happened, Waymo right now is in about 4 different cities versus the 10,000 that Uber's in. And if you look in San Francisco, where Waymo is, they've actually taken share from Uber, even though they're more expensive per ride. But people apparently like the cars are clean, the steadiness, the expectation. But the fact is, when you're in 4 markets versus 10,000, it's going to be a long way to go. And what's happened in Austin and Atlanta, Waymo has partnered with Uber. Where Uber is using their robo-taxis, they're taking over the maintenance, they're of the cars, Waymo's providing the cars, and of course they have great logistical system. They've had years to perfect it and continue to. So I think that there could be an interesting partnership. We'll see what happens at the end of these tests, but it could really reduce the cost for Uber because you don't have to pay drivers. And so, but I think this is a very long-term thing happening. Right. And I'm not so concerned about Tesla. They are very late entrants here. They're just testing in Austin with 10 to 12 robo-taxis versus Waymo has 100 right now, and they're going to have a couple hundred more coming in over the next year. So I think that it's more likely that Uber will benefit in partnerships, and they've got it's not just Waymo, but it's other companies. So they're really on top of this. So we'll see how that plays out.
All right. So the goodbye stands for now. Barbara, you're going to stick around, and coming up, we've got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, President Trump threatens 50% levies against Brazil, why Wall Street is shrugging off trade risk. Plus, we'll discuss the impacts of the trade war on industries from airlines to autos. And for today's Investor Playbook, we take a look at the potential winners and losers in the Magnificent Seven. Should a new member be added? Should we just get rid of the moniker entirely? We'll discuss. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. We continue to see a mixed picture. The NASDAQ, speaking of the Mag 7, is leading losses today. It's off by 0.25%. The S&P 500 little changed, up just 0.1%. And the Dow up more than 200 points, about 0.5%. As for the bond market here this morning, we've been seeing yields move a little bit, so similarly modest compared to what we are seeing in the equity market here. It's time now for our investor playbook. There's a growing divergence within that Magnificent Seven as companies like Nvidia hit $4 trillion in market cap. Not all names are continuing to outperform, so should we just be rethinking that name entirely? We've been talking about this for a little while, but it's time to talk about it again with Nvidia hitting that milestone. Joining me now, Invana Delevska, Spear Invest founder and CIO, and Barbara Duran, still with me, BD8 Capital Partners CEO and CIO. Ivana, we've been talking about this for a little while here because we have had these companies not moving as a monolith for quite a while here. So as an investor, how should people be thinking about the so-called Mag 7? Should we just be investing in individual companies?
Absolutely, Julie. So I think this has been a stock picker's market. The fundamentals for the different Mag 7 companies are very different. So if you look at companies like Nvidia, the fundamentals are very strong and we expect them to get stronger as we get to the second half. Google and Apple, on the other hand, their business models are under attack, right? So you're seeing new entrants coming in, you're seeing new technologies, you're seeing people hiring their top talent. So that is where they're more of like a show me story here, where they would need to do something different than what they're currently doing. And Tesla is pretty much in the penalty box, with what's been going on the political front. So I would say across the board, there is different fundamentals driving each company, which is why it's very important to be an active investor picking specific stocks, which is what we do.
I mean, it's interesting, Barbara. I'm looking at the 10 largest companies in the S&P 500, and yeah, Tesla's in there, but so is Broadcom, for example. JP Morgan is 10th largest stock in the S&P 500. There you see the concentration in the S&P 500, which has been rising again. So if you buy the S&P, you're getting heavy exposure to these kinds of companies. Do you agree with Ivana that you need to be kind of taking it case by case and doing some stock picking here?
Yeah, I agree. I definitely agree in general on the stock picking. And the Mag 7, though, it's an interesting moniker because it really became established when what the companies all had in common. They were all mega cap. They were all leaders in their fields, and they were all in groundbreaking technologies. Whether you're looking at Tesla was EVs, or it's e-commerce, or it's social media, or it's search. And the question is how much some of the leadership has slipped. And I think, I agree with Ivana in the names she mentioned. Alphabet is under attack in terms of their search business. They do have good AI, but can they keep up with the ChatGPTs of the world? We've seen what's happened with Tesla. They are no longer the leader. They are losing share, and they've had delays in introducing new models, cheaper things. So that's definitely a question mark there. And Apple's revenues are flat. They've really missed out on the AI. It looks like they're trying to go after that and really upgrade it, but they've missed there. So that is a question. Do those three still belong in the Mag 7? But the Mag 7 really is a proxy for looking at, these groundbreaking mega cap names that just have sustainable growth for some time to come.
Yeah, just to dig into a couple of these a little bit further here. When it comes to Alphabet, there's been some speculation reporting that ChatGPT might come out with its own browser. Ivana, how much of a threat would that be to Google and Alphabet?
Well, Julie, it's a real threat to Google, specifically because they've been kind of dropping the ball on the browser enhancements, right? So generative AI has now been around for 2 years. It should have been by now embedded into the Google browser, where the browser itself learns about what are the types of things you're doing and can assist you as an AI agent on the side. And this is what we're seeing companies like Perplexity bring to the market. They just launched a product this week, and similar with ChatGPT. I think the browser itself can be a lot smarter. I'm sure that Google has something like this in the works, but the fact that they're not leading the market with their established market share is a little concerning. So I think this is a real threat and a time where there's a lot of disruption and there could be some changes.
And there's also this war now for talent that seems to be emerging, with in particular Meta being really aggressive and going after executives. And then you have Apple on the other hand, who's having some of its executives poached. You just mentioned Perplexity, Ivana. Dan Ives of Wedbush was recently floated the idea that Apple should buy Perplexity. Do you think that would help it catch up if it made a big move like that?
I think Apple should make a big move of some sorts. I don't know if Perplexity is the one, and I don't know if they're a willing seller, because I think they have a pretty strong growth runway ahead. And the synergies with Apple, there would be some, but it's really a separate product on its own. So I think for Apple, where they are today, they definitely need to do something different, but I don't know that there is an obvious choice. Anthropic was another one that was floated. That's a model company. I don't know that models are really the way to go, because all companies have access to the models, they're open. So there is really no simple answer for what Apple should be doing. I don't know that Perplexity would solve all their problems.
In terms of the Mag 7, Barbara, I don't think we've mentioned Microsoft yet, have we? No. I don't know, where does Microsoft stand in all of this?
Well, Microsoft is definitely a key player, and it's because their business is so diverse in terms of their outlook and other applications that it often doesn't get thought of. But they have a big cloud business that is growing in a very healthy way. They're one of the big three players, and certainly their AI, is pretty good. And so nobody mentions what the stock has been doing well this year and should continue for the long term to do well.
Yeah, it's still it's trading near a record. It's off a little bit today. Ivana, what about you? Do you think that still deserves to sort of be a core holding when you're looking at large cap tech?
Absolutely. So Microsoft and Amazon are sort of in the middle. They're not among the top winners, but they're also not among the losers. So I think they're going to continue to compound from here. But I would say that due to their size, it is very difficult for them to come up with something so differentiated that will move the needle to the upside or the downside for that matter. So they're pretty good risk-reward investments here. But I think at this point where we are in the AI adoption cycle, it is worth for investors to take a little more risk and go into some of the more interesting names that have some more alpha potential.
Yeah, let's talk about those names a little bit, looking beyond the Mag 7 or whatever we're going to rename them. I've heard Mag Man. I don't know. There's been all kinds of different things that people have been floating for this. But Ivana, what are some of your top picks if you look beyond the largest cap tech?
Well, I think as a derivative plays on NVIDIA, I think the networking side of things looks very attractive. So basically the networking side of the data center value chain, these stocks have really pulled back this year. These are companies like Astera Labs, like Marvell. They really play a key role in the data center value chain, but they've really sold off as there were some challenges with NVIDIA's Blackwell launch, and then followed with some challenges on custom chips and how quickly they can come to market. They've really gotten hard hit here. So I think these are the types of names that investors should look at for second half. And then for slightly different risk reward, the cybersecurity space looks very attractive. AI is a major catalyst for that space, both on the opportunity side in terms of cyber attacks and products that need to be protected, like this ChatGPT and Perplexity models, and on embedding AI into their products. So this is another area that we think is very interesting, and this would be companies like Cloudflare and Zscaler.
And you mentioned risk reward looks a little different in terms of it being perhaps a little riskier, you're saying, in terms of the profile?
Well, it's riskier on a longer term basis, but interestingly, it's less risky on a shorter term basis. So they're already delivering. We already see upside to numbers versus the data center side. It's a little bit in the penalty box in the first half of this year. So these stocks are still underperforming versus the cyber stocks are up year to date, like 70% plus for some of them, like Zscaler and Cloudflare.
And Barb, I was just looking at one that we've sort of, I don't know, it feels a little forgotten, which is bizarre, which is Netflix. The stock is up like 40% year to date. It's trading near a record. We used to mention it in the same breath as some of these other Mag 7 names, and we don't anymore, which is a strange thing to think that Netflix could be overlooked.
Well, I don't know if Netflix is overlooked at this point. It's a core holding for me. I love Netflix, and I think they've got much more growth to come, even though the stock is reaching new highs and looks expensive on a PE basis. I think why it's probably not part of a Mag 7 technically is that they're only AI. They're just now implementing in-house their own advertising algorithms, to help do what Meta's done, to increase their engagement and their ad targeting. And Netflix is just getting there, and they're not there quite yet. So, and they're also not in the mega cap category. They're only $500 billion.
Only.
Yes, only in the mega cap area. Whereas even a Broadcom is at 1.3 trillion. And Broadcom, could be considered, it's maybe not differentiated enough from NVIDIA, although it is a different business, but it's the same play in terms of what's going on in that space. But Netflix is not forgotten, but it probably shouldn't be technically a Mag 7, but definitely a core holding in my view.
Ivana, Barbara, thank you so much. Appreciate it. Coming up, the top performing sector in the S&P 500 this year is not tech. We'll tell you what it is. With stocks trading near record highs, we're taking a look at the outperformers this year. The industrial sector is the top performer in the S&P 500 this year. It's up around 14%. It's been boosted by momentum from aerospace and defense names, which account for nearly 30% of the sector's return so far this year. But of course, there may be risks to the rally ahead. President Trump announcing that 50% tariff rate on copper effective August 1st, and we've got some other trade headwinds as well. Joining me now, Jonathan Secreta, CFRA research analyst. Jonathan, thanks so much for being here. So I guess, first of all, big picture, it's maybe a little bit surprising to folks that industrials have done so well. What do you think has been sort of the main driver or drivers that have been behind that performance?
Good morning, Julie. Happy to be here. I'd say the main drivers, if you look at the underlying components of the sector, as you mentioned, aerospace and defense is a large individual component. If you look at Boeing, Airbus, they're up over 30% year to date, which I know a lot of the narrative is focusing on tech names, but I think that strong performance is really tied to finally a ramp up in production. And this is something that investors have been waiting for quite some time. You also have the defense side of that. Global defense spending set to rise on geopolitical tensions globally. So a really strong demand outlook ahead for this component of the sector. Also, you have strong electrical generation markets. The data center build out is quite dramatic currently, thanks to a lot of big tech spending. So the performance here has been quite significant. If you think about electrical infrastructure and what's needed as far as updating the grid, as far as building out data centers, the cooling systems, power generation, and management systems, this is a critical sector to really make all of that happen. So really the AI revolution, in order for any of this to take place, you need the industrial sector to be thriving.
So I want to take some of those subsectors and talk about what happens now and what's priced in. So if we start with aerospace and defense, for example, and you've got for Howmet Aerospace, I believe in the S&P 500 industrials is the best performer this year. But as you mentioned, you've got a Boeing, you've got RTX that's among the top performers. So if we're looking at that global defense spending environment, how much of that is now priced into the stocks?
I'd say there's still more room to go for aerospace and defense companies. It was a laggard. Really, fixed price contracts were quite a detriment for the space as inflation was rising higher. A lot of aerospace companies had to really eat the costs. So we've seen kind of somewhat of a coiled spring here, where now we're starting to anniversary some of those fixed price headwinds. There's been a shift towards more variable cost plus contracts, which has really helped. So I think we haven't really seen the gains in margins that we haven't really realized that quite yet. So I think there are more gains as far as an upward trajectory in earnings growth for the space. So I wouldn't say either the ramp up in aircraft production rates or the benefits from defense spending have really clicked yet.
Jonathan, I also want to ask you about two companies that used to be one company. I'm talking about GE Vernova and GE, both of which have done really well this year. Obviously, They now do different things. But is this a situation where indeed breaking up something did unlock the value? And do you think those each have some continued room to go up?
Absolutely. And this has been a trend we've seen across the sector. Really, the conglomerate type structure is going the way of the dinosaur. This is something that we've seen a very large shift away from. Typically, conglomerates, they suffer from a lower multiple. There's less synergies at play. There's also a lot of conflicts for R&D spend. They lag behind more focused peers. for much more linear in their capital investment allocation outlays. So it's been a very popular shift. Right now, if you look at, say, 3M, they spun off their healthcare business. Currently, Honeywell International is in the process. So we think it's definitely a value creation play here. We think that the sector is becoming very innovative. If you're not introducing new products, that means you're not able to maintain pricing power, not able to defend market share. So as far as GE Vernova and the split up of their aerospace defense, it's been very good for their business. And also communicating to investors, what is the growth story? What's the growth narrative? That's difficult to do when you have so many disparate parts of the business pushing and pulling on the earnings trajectory. So we think they have a long runway for growing as independent businesses. We think this is a positive overall for individual names within the sector that are becoming a lot more focused and lean.
At the top, Jonathan, I did mention one potential risk for many of companies in the sector is this potential 50% tariff on copper. How much of a headwind could that be if it does go into effect? And I guess, do you expect it to actually go into effect?
Right. So just like any other announcement, there is what's declared and then ultimately what settles and sticks. So really huge uncertainty there. In a matter of a few hours, that could change. But if we do take the assumption that this is going to go through, it will have an effect on the economy, right? So almost half of our copper is imported to the U.S. This is the third most consumed metal globally. So it is a critical component of the industrial manufacturing economy. But I would say there are some buffers here. One is there has been some stockpiling of copper, this raw material, because the expectation was at some point we would see some tariffs in this regard. Also, at this point, a lot of them industrial manufacturers, they have a battle-proven playbook to go off of offsetting raw material cost inflation. Right. So over the past several years, they've had to contend with this headwind. So really through pricing, we think ultimately they're going to be successfully combating it. Near-term margin pressures, absolutely. But if you've seen industrial margins from the inflationary period, they have recovered. Like I said, they're very good about pushing pricing. It's almost helpful to think about these tariffs as a pass-through cost ultimately to the consumer. So our concern is ultimately demand destruction that could propel us into recession. 50%, this is a punitive degree of tariffs, but we think there are ways manufacturers in the near term are going to combat it to limit impacts.
Interesting stuff, Jonathan. Thank you so much for joining us. Appreciate it.
Absolutely. Thank you.
Well, let's stick with this focus on tariffs because shares of BMW rising nearly 4% after a call reaffirming its auto margins for the second quarter and full year. It's the rare piece of good news from German automakers. They have been warning they'll be taking a hit from U.S. tariffs. Yahoo Finance senior reporter Prasad Ramani is here with the details. So how did BMW manage to navigate this better?
I'm a little surprised they're able to do that. I mean, they had talked about how they would take a tariff hit, and they were price protecting some U.S. models through May. It seems they've stopped doing that. They've raised prices on some cars that are built in Mexico, so that might be how they're maintaining some of their margins. They're leaning on their European operations, and China a bit weak here, so they're going to try to defray some of that with that. But expectations-wise, I think they might be expecting a trade deal. I think they think there's a trade deal happening potentially in July with that 10% deal, and that maybe they kind of see that happening. They're more positive about than other automakers. I think that's why they're able to sort of maintain that profit margin expectation. Plus, they also, a big part of it is they build a lot of their SUVs in America, and they export them to the rest of the world. So that's no tariffs there. So maybe that's part of why they're able to see that they can maintain some of the profitability in light of tariffs.
And so what about the rest? Because obviously if BMW is the outlier, that means the other German automakers, and I'm guessing European automakers more broadly are struggling with this?
Yeah. Mercedes and Porsche are struggling here. Mercedes, even though they have operations in Alabama, they saw sales dip in the U.S. They price protected all 2025 models if you order one car today, they'll still price protect you. So they're absorbing that cost. They're seeing that bring down some of their sales there in the U.S. Porsche, on the other hand, actually saw saw sales rise in the U.S., but they attribute it to the fact that they have all this pre-tariff inventory they were selling off. They were eating the costs, and they're probably not going to keep doing that. And they make all their vehicles in Germany and some in Slovenia, so they're really tied to the tariff situation. They're probably hoping that they're going to see this deal come through. So right now, they're really the ones that are sort of struggling the most in terms of tariff exposure.
Prost, thank you. Appreciate it. We got much more markets action coming up. Stay tuned. You're watching Market Catalyst. Now time for some of today's trending tickers. We are watching Autodesk and software provider PTC, as well as Workday and Estee Lauder. First up, Autodesk weighing an acquisition of rival software provider PTC. That's according to Bloomberg. Autodesk reportedly weighing a cash and stock deal for the company. PTC also drawing interest from others within the industry. This comes as we continue to see consolidation in the industrial software space with the shifting adoption of AI. Both these companies sort of engineering software makers, and you see them both down, which is maybe a little bit surprising, right? PTC, when this report crossed late yesterday, did see a spike in the shares, but then came down from those levels. So that's why we are currently seeing it lower. But it also could be a reflection that investors don't see this deal as likely to get done. Starbird is one of the is an activist investor involved in Autodesk. So some analysts have reportedly questioned whether it would be realistic to get this deal done. PTC shares, by the way, just looking at the year-to-date chart on Yahoo Finance, they're up about 8% over year to date and up about 12% over the past year. So it's not as though they are pricing in a huge likelihood of being bought out, but we shall see. Next up, we got Piper Sandler turning cautious on Workday, cutting its rating to underweight from neutral. The firm citing increasing risk from AI, resulting in reduced appetite for Workday software. Analysts see profit margins potentially shrinking. The price target cut to $235, reflecting downside from the stock's last close, although now with the stock falling today, it's above where it is currently trading. And by the way, Piper Sandler now in the minority when it comes to being negative on Workday. The majority of the folks who rate that stock do not have sell equivalent ratings. And effectively what this call is that with the rise of AI, there will be fewer workers who might be using Workday. That seems to be here what Piper Sandler is saying in this call. And finally, Bank of America reinstating coverage of Estee Lauder with a buy rating and a $110 price target. That would imply 30% potential upside from yesterday's close. The firm expressing confidence in the company's Beauty Reimagined plan, which involves cost cutting, product innovation, increasing use of AI, and boosting consumer marketing. The shares today are up about 6% on this particular call. The stock, by the way, is up more than 20% year to date, although it has fallen over the past year. So that's sort of the context when it comes to share price movement for what we're seeing today. And as always with our trending tickers, you can scan the QR code below to track the best and worst performing stocks on our trending tickers page. Well, we've got much more markets action coming up, including a new offering from Interactive Brokers. We'll be right back. Interactive Brokers is investing in the next generation of investors. The electronic broker announcing the launch of IBKR Investmentor. It's a mobile app offering accessible educational content to set wannabe investors up for success. Joining me now, an exclusive interview, Thomas Peterffy, founder and chairman of Interactive Brokers. Thomas, it's always great to get some time with you. How did this come about? Because I don't think of you guys as sort of a financial education company. I think of you sort of as oriented more towards more active investors, maybe even more professional investors. So where does this fit in for you guys?
So this is not necessarily for Interactive Brokers getting more customers in the immediate future. It is more about educating people all over the world about, in a very simple and easy way, to learn about the fundamentals of economics, business, and investing. And you do not have to be an Interactive Brokers customer, and it's completely free and available to anybody, anywhere around the world, and it is absolutely free. And you don't have any commitments, you don't have to make any commitments, and it's just there to learn easily. I think that the way we nowadays teach economics and business in schools, it is just way too complicated, and it confuses people, and many people give up and find the whole idea inaccessible, and they begin to tend towards moving towards socialism because they just don't understand it. It's beyond them. So I think that a simple way to learn about economics and business is highly overdue.
And what do you think are those sort of simple, basic tenets of economics and finance that that are sort of most important for people to know?
I think it's important to know that it is a natural thing. Free exchange is people thousands of years ago have realized that, if I have more of something and need something else, we just barter, we just trade. It comes about naturally. And therefore the free market economy and free market way of organizing society is a natural way of doing it, and it's just way over complicated nowadays. And so I'd like to get back to the origins of how economics and business basically came about.
And where did this idea come from? I understand it was from a conversation with a young employee there?
Yes, it's a young man, he was 22 at the time, I think, and we were just talking about this, and I said, well, why don't you go ahead and come up with something? And he did, and I think it's fantastic. So we really, really like it.
And it's interesting to come out with something like this, too, at a time when AI is becoming more popular, right? Because you have to wonder if these sort of tools at some point in the future will just become obsolete and everybody will just ask ChatGPT or Perplexity or what have you questions about economics and finance. Do you think that is a good thing on balance eventually, that people might be learning that way?
Absolutely, as long as those answers are correct, right? Absolutely, I think AI is fantastic. I personally love it. Yeah.
Thomas, while I have you, and I know you guys are reporting earnings in a week, so I don't know how much you can say, but I am curious what kind of demand and activity. I mean, we've got stocks near record highs now, even if we're seeing a little bit of recent rockiness. But are you continuing to see a lot of demand amidst that record high push, but also some of the volatility we've been seeing?
Well, business is just progressing, very steadily growing. It is basically a fantastic environment, and I don't see anything in the way of continuing to progress in the same manner.
Do you think that, or I should say, how many interest rate cuts do you think we might get this year? And then what effect does that have on your business?
I think we'll get one or two at the most. Actually, we are not as dependent on interest rates as many other brokers because we pay interest on all the cash. We pay 0.5% under Fed funds rates for people who have cash in their accounts, and we charge them 0.5% over Fed fund rates on margin loans. So we basically make 1% in between, and we make that no matter whether interest rates are 2% or 10%. So it doesn't really impact us much.
What camp are you in terms of where you think rates should be going? Do you agree with the president that the Fed should have begun to cut already?
Well, I cannot gauge first of all, I think that given the large deficits, interest rates will, in the 1, 2, 3 years down the road, will be much higher than they are today. So, whether we cut now a little bit and then or stay the same, I don't think it will make much difference. The more we cut now in the short term, the more we'll have to raise later on. So.
Well, and I'm glad you brought up deficits, because I think that goes back to the idea of financial education, too, because government deficits, even though people in Washington talk about them, I don't think most Americans think that much about them, right? Is that something that they should be concerned about? Is it something you're concerned about?
Well, I don't think it will make a heck of a lot of difference for the average person because, it's like devaluing the money by some percentage, right? It basically wages will go up, prices will go up, everything just goes up together. So I do not understand why people are so concerned about it. It's money has been becoming cheaper and cheaper ever since I came to America 60 years ago.
Right, and deficits have continued to go up, and to your point, money has continued to get cheaper here over time.
So the takeaway is that it's good to invest in stocks because stocks rise with inflation rates, right?
Yeah,
and so it is good to invest in real estate. So people should try to save their money and invest because that gives them a free ride. Inflation gives them a free ride.
To go back to the beginning for just a moment, do you think that people are more educated than they used to be on balance about finance and economics?
No, I think they are less educated. Mm-hmm. And with the rise of Mamdani in New York City, that's very clearly most young people do not understand, and educated young people do not understand what economics and business is all about. It's very clear to me. It is frustrating.
Well, I think that, in part, his rise seems to be tied to the fact that people can't afford to live in New York City, right? That they have issues with finding housing, et cetera. What do you think is a better way to attack those kinds of issues?
Well, first of all, people don't need to live in New York City. If New York City prices itself out, people will move elsewhere and prices will come down. So supply and demand, it's always, why do people need to live in New York City? There are so many other places that are much cleaner and nicer. So that's what I think.
I'm a fan of New York City myself, but I understand your take. Thomas, it's always great to get some time with you, sir. Appreciate it.
Thank you very much.
Take care. Bye. Coming up next, we're going to talk more about the president's tariffs and the political impact. Stay tuned. You're watching Market Catalysts. President Trump threatening Brazil with a 50% tariff on all imports into the U.S. Trump cited what he calls a witch hunt against the country's former president as a motivator for the decision, suggesting that Trump's personal politics are increasingly factoring into tariff decisions. Jair Bolsonaro, who has bragged about his closeness with Trump, is facing trial for allegedly attempting to stage a coup against current leader Lula da Silva. Here to make sense of it all, senior columnist Rick Newman. Rick, and I wanted to get your take on this because this does seem to be, it's of a piece with President Trump's moves generally, but is a new move in the tariff situation, yes?
I think you could call it tariff mission creep. Trump's tariffs up till now, I mean, there's been a common thread to all of them, whether they're the ones he's actually imposed or just threatened. Trump almost always goes after countries that have a trade surplus with the United States. In other words, we buy more of their stuff than they buy of ours. Trump says that's unfair, and he wants to rectify that by either getting those countries to buy more American goods, more American exports, or relocate some of their production to the United States. Guess what? The United States has a trade surplus, not a trade deficit with Brazil. We sell them more stuff than they sell to us, which is exactly the type of trade circumstance Trump says he wants to see everywhere. And yet he's now saying he wants to impose a 50% tariff on imports from Brazil. I think it's pretty obvious. This has nothing to do with Trump's economic aims. I think this might be the first time he has threatened a tariff really for political, or you might even just say personal reasons. I mean, this is like a new category of tariff. Call it the buddy tariff. Trump wants to help his buddy, Bolsonaro, So he threatens a whole country with tariffs on their imports unless they stop this prosecution.
And of course, Lula has fired back against this, saying he doesn't want the U.S. to be involved in its internal politics.
Right.
Terry Wiseman, who is heads up global FX strategy at Macquarie, called it a scary precedent in a note that he put out to investors. And he said, moreover, Trump's interference can backfire in a way that's also not good for Brazil. You know, if it affects the election in the opposite way, right? And maybe even makes Lula more popular there. We saw that in Canada, right? When President Trump sort of pushed against that country, it seemed to affect the election there. So I guess there are risks of unattended consequences for Trump in getting involved in these ways. Yeah,
and so this tariff supposedly will go into effect on August 1st, unless, I guess, the government stops the prosecution of Bolsonaro, or it develops in some other way Trump considers satisfactory. But I think this is going to turn into a showdown, Julie. I mean, no country. I mean, imagine if some other country tried to bully an American president into saying, change the way you're prosecuting somebody, or change your laws because I demand. I mean, almost any country would resist this. There are some countries are very vulnerable to the Trump tariffs, like Vietnam is very vulnerable, and they're going to try to do what they can to get out from them. China is pretty vulnerable. Brazil, not that vulnerable. So I've seen some economic analysis saying that if this actually goes into effect, it might hurt Brazil's GDP growth by 1/10 or 2/10 of a percentage point, let's say. So Lula probably has the leverage to say, we don't want this to happen, but we're not going to cave on this. So this could be one that goes to the mat.
More to take a step back, just quickly here, Rick, how the tariffs are currently playing politically with the American public. We've seen the market shrug them off. Do you think American voters have?
American voters are generally, clearly not following every country because who can, honestly, given how often it changes. But there are definitely polls showing that it's almost like 2/3 now. It could be even close to 3/4 of Americans don't like the tariffs. They get the message that tariffs are going to raise prices on Americans. There's an interesting gap here, though, because the tariffs have actually not yet really raised prices in ways I think that are noticeable to most Americans. So what you see from polls is people think it's coming, and economists say it is coming, but people just haven't seen it yet. So I think there's a real risk for Trump here because sentiment is basically against the tariffs, and people are just waiting to see something bad happen at prices in the aisles of stores. And they are going to see price increases. I mean, it's not going to be 50% price increases. It's not going to be as bad as inflation in 2022. But people are going to notice. Some things are going to go up by 10, 15, or 20% as soon as pre-tariff inventories are gone and post-tariff inventories start to come in. So I think this is going to turn out to be a net negative for Trump.
Yeah, if these 50% tariffs in Brazil go into effect, keep an eye on your coffee, Rick.
I know.
Thanks so much for being here. Appreciate it. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We've got much more Yahoo Finance coming up throughout the day.